That's where the challenge is. As a bottom line or a top line fader, the challenge isn't about defining momentum. The challenge is about defining the value of value. The challenge is about pricing value properly. Yes? As a bottom line fader, it's all about pricing value properly. It's about knowing how much value is buyable and how much value is sellable. As a momentum trader, it's not so much about value. Of course, value becomes incredibly important, but it's about order flow. It's an order flow trade when you move into momentum trading, isn't it? Because momentum trading is about recognizing momentum. It's as simple as that. But also it's about recognizing who the weak traders are. Hold on a second. As a momentum trader, all you're trying to do is make sure you don't buy into commercial selling or sell into commercial buying. So in other words, do the opposite to what you need. Anything else goes, because you're still trading against a weak seller, whether they've got value or whether they've not got value. You're still trading into a weak seller, agreed? So how do you define change of structure? Change of structure can come from VWAP, moving averages, a trend line if you want, or the basic structure components of a buyer at higher prices or seller at lower prices. So during this structure here, we got a new break lower. This price became the high. So you'd be obviously selling into that drop lower. Now, you obviously don't get a failed auction in there, but there's obviously inside these candles, there's failed auctions all over the place, right? So we break structure low, you get a failed auction pop, and then you'd have been able to get a sell trade in here. And then you get a failed auction here, you'd have been able to get a sell trade in there. And then you don't get a failed auction here. They would have possibly have had a sell trade somewhere in here, but it doesn't happen. You now break structure to the buy side, right? So you've now broken structure, correct? So you're now bullish. You're going to buy against the sellers. The first failed auction here, you could have put a buy trade in here and a nice squeeze, but a failed auction. Well, not really a failed auction. It was a level 2 seller came in. So obviously you let it go through. And then it comes up and then it fails. Remember, this is your low price here, so you're not breaking any sell side structures. So you've then got another opportunity. You get another failed auction here, so you could have went in for a buy trade there. And again, you break structure again at that stage, don't you? You break structure, so a very nice profitable trade, 2 out of 2. Because you break structure here, this is now your low price here for structure break. As the price then auctions down, you get a failed auction coming back up on a macro chart. You might decide to go for a buy trade in here. You haven't broken structure yet, so you're waiting for the next failed auction, which happens there. So you could have bought there. And another winning trade, another couple of winning trades. Boom, straight into monies. New break of structure, failed auction, a buy trade perhaps here that gets scratched or lost 2 or 3 ticks. And then another buy trade in here. Beautiful winning trade outcome. Failed auction, new high price, of course, new high price. And if that's the new high price, this is your current low price. So with that failed auction, you're going to try and come back in again somewhere in here. Another failed auction here, break of structure, break of structure. So if that's your break of structure, this is your new low price. Failed auction, another buy trade. High price, price trades down, trades back up. You start buying in for the failed auction, buying in for the failed auction. And you get another successful break to the upside. This is now your low price here. So after that break to the upside, you're now looking at the price coming down, coming back up, buy side trade there. You got a stop out for 3 ticks. Stop out for 3 ticks. But you can also recognize on that stop out for 3 ticks what's happened. The top line's become sticky, hasn't it? You're trading into a VWAP. So would you be buying this? This is where the momentum traders have to define properly and clearly. The momentum trade is more likely to be order flow. The momentum trade is more likely to be order flow. So when the order flow gets sticky up here, you probably don't want to be buying into that trade, right? So you say, you know what, I'm off. I'm off my momentum trades at this stage. I'm waiting for something new to develop. And that something new to develop obviously ends up sending a sell side signal into the markets here with a failed auction here. So you could have potentially have sold with a momentum coming back in on the sell side there. You can start the whole process again, re-anchor the process. Another sell here, momentum still selling, slippy still selling, so you go back in again selling there. Brilliant, loving it. And then another failed auction coming in and a possible sell coming in here and another break and then a break off the level here and break structure and you go, okay, now we're bullish. Failed auction in that red candle perhaps gets you into a buy trade here. Failed auction in this candle perhaps gets you into a buy trade here, gets you some profits and scratches. And that's the end of that trade as well, because now the auction is broken, sell, and obviously the low of the structure still is in here. So you're still thinking about this as a possible buy reversal trade for a press back towards the trade, right? Now, obviously, you've got a challenge up here because if you use the VWAP, none of those buy trades would have been buys, would they? The only trades you would have taken were sell trades. So the only trade you would have worked on these would have been the basic short sell. So that's where your definition becomes your business plan, doesn't it? Your business plan is what that definition is of what the structure needs to be before you're going to trade momentum. You can simply use an indicator called momentum. Surprisingly enough, there is an indicator called momentum in the markets. And you could use something like that, right? So you could start adding a momentum indicator to the markets. And if it's not in line with you, if it's diverging against you, you simply don't trade it. And that's perfectly valid, guys. Absolutely nothing wrong with that type of thing as well. The idea is when momentum dries up, what the hell would you be selling into a drying up of momentum in the first place anyway for? The momentum shifted, press when the momentum is with you, or the rate of change is with you. When the rate of change is improving, press it and keep pressing it, right? Kind of makes a little bit of sense. So for example, if I looked at momentum on the bond, remember I just shouted the 12 sell. Well, I just shouted the 12 sell that we'd shifted. Look at the momentum on the 12 sell, guys. Look at that momentum line, look. See momentum? Well, the momentum's obviously shifted. So the thing, if you're looking at a trade against momentum, is you'd never have bought there, would you? And you'd never have bought that press higher there, would you? So based on that, as a fade trader, you now know that the algorithms probably aren't buying it, because if they were, the momentum would show as a positive pop, right? So if the algorithms aren't buying this, of course, this must be market manipulation. So we shouted a sell at 12. You can see what happened. I shouted a sell at 12 at that stage there. And we said, this looks like it's done and dusted, guys. This looks like it's sticky for the first time. And guess what happened? We absolutely killed it, didn't we? We absolutely killed it. Big sell. Momentum's now shifting. And then momentum dries up. So that's it. It's finished on the short sell. Finished on the short sell now. Simple, easy algorithms to just put on your charts, recognize it happening, and pay attention to it as a momentum trader. Looking at that in terms of the market momentum should basically be the same as what? It should be basically the same as a sticky algorithm, shouldn't it? Do you agree with that? It should be basically the same as the stickiness inside of the market deltas. Because if the stickiness is sticking, that would suggest momentum is going to start drying up in terms of a physical outcome, correct? Well, let's compare like with like for a second. Let's do that comparison, since everybody balks at the idea of indicators for whatever reason, simply because of lack of knowledge of them, perhaps. But if we look at how the comparison of momentum versus slippiness, can we see any similarities between the two? Same top edge, same time frame, guys. Same top edge, same time frame. What do you think? So you can see that the drive higher here in terms of the slippiness, and obviously the drive higher in terms of the slippiness, right? The high price eventually on the slippy, I mean, it kind of started to diverge here, but the high price on the slippies here came in at 20. I've cut off too many candles here, guys. My mistake. My apologies. Cut off too many candles. So we'll have to add a little bit back in here at 1320, but you can see that the market slip here, it doesn't make any difference. We don't have to bother adding it back in, it'll just waste time. But take a look at what happened at the very top edge from about 1400 onwards. Do you see what happened? 1400 onwards. Can you recognize that shift taking place in terms of the sticky? 1350. See the same points on the screens? 1350, 1350. The delta started to change. You see that? The momentum started to drive off on the retests. Yeah. The momentum started to drive off on the retests. Well, lagging indicator suggests that it's lagging. It's not lagging. It's just showing you what the previous prices were, if you like. You know, so you can look at it as a lagging indicator, or you can just look at it as an indicator that's giving you some information about what's happened before. Well, what's happened before is obviously always going to be historical. So I can't really say it's a lagging indicator. Indicators don't lag. Indicators don't lag, do they? I mean, it's not like you've got a lag on an indicator. It just shows you what it is you ask it to show you. You know, if I improve the speed of this indicator to 2 candles, it shows me what I'm asking it to show me, which is 2 candles ago. Know what I mean? So I'm being obviously a little bit, defensive of that word lagging, because it's only lagging for as much as you want it to lag. It's up to you how much you want to see in terms of historical information. What it is showing you is that the momentum is drying up. But it can only show you that in hindsight, can't it? It doesn't predict the momentum's drying up. It shows you that momentum's drying up. Yeah? So it's not a predictor. It tells me nothing about the future whatsoever. That's what is true about indicators. They show me nothing about the future. What they do show me is what's happened. So if you don't have the ability to spot the market's getting sticky, then of course this indicator can help you. Yeah, absolutely. The indicator can help you. So obviously it shows you what's happened. It has got stickier to the top side. And that stickiness has resulted in a top line sell, and you've made some money because you've been able to read that bit of market shape, yeah? Does that make sense? It helps identifying, absolutely helps identifying stickiness, you know, but it's a momentum indicator, so it doesn't trend. So you're not going to get it's not as good as, for example, the tick delta, because the tick delta will give you a lot of trending moves. It doesn't trend, so it's like a stochastic in that sense. So it's always going to be wrong fading highs and always going to be wrong fading lows in a trending market. So you can obviously see that if I zoom the bond chart out, that's where this problem lies. But that's not what it's set up to do. It never intended, it never claimed to be able to trend trade, right? Nobody's ever claimed to trend trade using stochastics or momentums or whatever. It shows individual swings simply over the period that you place into the calculation. So it's not going to look at the last 500 candles unless you change the momentum to, guess what? 500 candles, right? So if you change the momentum to 500 candles, it'll be a lot trendy looking. And there it is. Look, it looks just like price, doesn't it? So, you know, it's those types of things that you can start spotting. I mean, it just becomes basically the price at the end of the day. That's all it becomes. So obviously, you can, you know, it's all user dependent. Everything about this is user dependent. You know, if I do it as a one candle, then it's the momentum of one candle ago against the current candle. Sometimes it'll be bigger and sometimes it'll be smaller. If I change it to 5, it'll chop and change an awful lot over just 5 candles, right? So over 5 candles, because of that very large down candle, you can see that the momentum shifts very quickly to the downside. And these 2 small candles don't reverse that last big down candle's momentum, do they? The only reversal of that big down candle's momentum happens when we get the big up candle starting to kick off, but it still takes into account the last 5 candles. So that's 1, 2, 3, 4. So at this stage, the momentum still is actually 0. It hasn't built new buy side momentum. It's just negated the sell side momentum, hasn't it? It's just negated the sell side momentum. So you can start to recognize the fact that any upside is constantly being negated by recognizing that little slope there. So you can actually start to spot some of these little clues, can't you? You can start to spot some of the clues in these little things. Depending upon the settings that you use, you can change it to whatever you like. But again, it's user preference. It's not something that you're going to start wasting your whole entire life doing, which is what most retail traders do, is they waste most of their life working on settings. If you're going to use a bloody indicator, get a setting and stick with it. Don't change it. Don't chop it. It's not going to make a hell of a difference whatsoever, whatever setting you use. Just find something that helps you to identify something and then stick with it. Don't start becoming that idiot that starts playing around with every different setting and filters and all that shit. That's just bollocks. Absolute rubbish. You can see the dealers cut their losses today, didn't they? How did we recognize that the dealers just cut their losses today? They basically just scratched their whole entire day today, didn't they? Well, we can see that because they obviously sold as soon as they got to the straddle line. Do you see that? So the open gap down, they got back to the straddle line, which means how much money have they made? 0. How much money have they lost? 0, right? They made nothing. They lost nothing. And obviously, because they started to sell there, they've basically just came in and says, you know what, we're just scratching our day. I don't think we're going to get our money back today. And you see that? I don't think we're going to get my money back. So they've obviously just worked the short sale against their straddle level, and they've just worked their trade against the straddle level. They're worried about the downside, and they simply just say, you know what, I'm out. I'm out. Straight to the pub, Paul. Once they've got their delta 100% hedged, they can go straight to the pub if they want. Because it doesn't matter if it goes up or down at that stage, they simply can't make any money. It's a 0 day for them, right? It's a 0 day. The challenge you've got with that is it means that they're going to have to buy that trade back tonight, though, because they're now short stocks. You know what I mean? Does that make sense? If you're short stocks in here, your delta 0. But if this is the 24-hour delta, that delta becomes a 0 at the end of the day, and you're still short stocks, right? So at some stage, they're going to have to buy that trade back before the end of the day. Yeah. So if they started to sense that conditions were starting to improve, then obviously they could start making that trade out at any stage. They might start buying the low price, in which case, by the time it got back to this price, they're actually making profits, right? So they're currently heavy short stocks. They can buy those stocks back at any stage, but that means that they open themselves to a big downside swing. Why would they possibly buy back stocks? Perhaps they see some big rotations coming in. Perhaps they see some price action showing up, suggesting that volatility is getting sold into these low prices. And at the present moment, do we see that? At the present moment, do we see that volatility getting sold into the bottom edges? Not a chance, right? Not a chance. So it wouldn't be me as a dealer. Certainly would not be me as a dealer at this stage, guys. No chance, no chance at all. Now, here's one of the positives. This is the TED spread for today. This is the TED spread. So one of the positives for the TED spread today is that we don't see the same contagion on this downtick. We don't see the same contagion on the downtick at the present moment based on how the TED spread's been behaving this morning. So there is a little bit of positive news for these guys. Is what it is. Take your punt. Perhaps we should have got Amin and Paul to do the exercise again and see what they would be doing in these situations. But I don't like taking the guys off their trades. So, I don't like doing too many of these exercises. It keeps people away from making some monies. Making some monies. My God, are we making some monies today? We've touched on a lot of questions today in terms of bits and bobs, bits and bobs and bits and bobs, bits and bobs and bits and bobs. Dealers' keys have been pretty good. I did give a shout earlier on today about that 38.40. Did anybody note it down and play? I sent out a little tweet earlier about that 38.40 wholesale price level, the tie-in with the 12,000 NASDAQ. If you pay attention to these things, you can make some money, Scott. If you pay attention to these things, you can make some monies. Now, did I tweet that information or did I just shout it in the room? Yep, we tweeted it. So you can see the tweet here. Came right off the bottom line key defended level, and you can see that from the tweet there, 38.40 is right in the meat of that area there, right? 38.40 is right in the meat of that area. So obviously, when you're looking at that as a possible play, you can actually recognize exactly how this morning's evolved from these keys, and obviously that's important because obviously this is the whole point about having them in the first place. So when we look at that 1340 trade and we see what happened after the trade took place, here's what happened since then. So there was the original tweet, was in here, right? That was the original tweet bounce. And then it's obviously came back and retested into that key reference there. And then this key became important. And then this key became important here, didn't it? So you've been able to see how the price has revolved and rotated around these keys. And the hope is, of course, that the buyers come back in off this 38.50 for the bulls. That's also the same as the 12,040 for the NASDAQ. And you can obviously see that tie in between those two key references in the current price action at the moment.